Welcome to this webinar on Sphere. The title of the webinar is What Makes the World Go Round? There is a very important foundation on which personal finance and investing has to happen, which is you should be able to find investment opportunities at all times. When I say investment opportunities, it need not be only in one asset class. You should be able to find the right investment opportunity at every point in time if you want your personal finance to become stronger and richer. It's important to have your personal finance always aligned to those opportunities, and you need to carry your personal finance forward through different times, difficult times, and rewarding times. Whatever may be the context, you should be able to participate consistently. Because in personal finance, the most important thing is what you do with your savings, because you are going to save almost regularly. You will need to deploy that money all the time, and you have to bring in two things into your personal finance. The first one is efficiency, and the second one is productivity. When I mean efficiency, you should be able to spot the right opportunity early, or at least before it is too late. Between early and too late is a long time gap, but despite the time gap being reasonable and long enough, most of us don't participate. Now that directly leads to inefficiency, because if you don't participate, then your efficiency is a casualty. When your participation in opportunity is not efficient or not efficient enough, then the productivity of your savings and capital is going to be a casualty. So in personal finance, the two watchwords are efficiency and productivity. Our endeavor in ithought from day one has been how we can make a difference to these two aspects. How can we bring more efficiency and improve the productivity? Along this journey of over 12 years, we have tried to do this in the most difficult space, which is financial products. And while doing this, we have always been conscious about what kind of risks we take, how these risks are aligned to the investor, and how our investing is always going to respect the risk profile of the investor. Now, whatever I've said here sounds simple, but this is where most of the follies and fumbles of personal finance happen. Because most of our focus is on returns. And when you focus only on returns, you tend to misalign often from your risk profile. So you move away from your risk profile and do something. Now, this is something we have consciously avoided in whatever we did in ithought, and we have done it for the longest time in the way we have done. We have managed financial products and curated strategies using financial products as the core. That is where the RIA has played a significant role in our evolution. If you have a parallel experience of dealing with the conventional personal finance platforms or conventional streams of personal finance like bank relationships, you will constantly be comparing, and you'll realize that what we are doing would be something which they either don't agree or never do or never place before you, or sometimes vehemently disagree also. But yet, if you look at what you have managed even in this, you will find that you have met your financial goals reasonably. You've beaten inflation over very long periods of time. You've beaten it by a reasonable distance. And you always slept peacefully while following this approach. But there comes a time when every model of investing, every stream of investing develops fatigue, develops inefficiency, and as a consequence loses productivity. We felt that during the period of COVID, even in the RIA. The reason was, when you see very extreme sentiments, investors find it difficult to cope with those sentiments, and decisions simply are never taken actually. This would mean that all your incremental actions which you can take during those times tend to get deferred. Naturally, efficiency will be a casualty, and productivity consequently will also be a little bit softer. Having said that, it is not just during COVID. This is something that we have lived with throughout our RIA experience. Yet, the outcome for the whole community of investors whom we have worked with has been reasonable, and it also gives us the confidence that there is more potential to improve the efficiency, raise the productivity, and deliver a better outcome. So the outcome can actually be better. Something like Sphere, which is basically built on the foundations of the RIA, but built with far more sophistication, is not the effort of one person. It's the effort of a team. And in this presentation, I would like to first introduce the team to you briefly. They're all in the meeting, and you have Niranjan, who heads this investment strategy for Sphere. You have Samyukta, who is the principal for fixed income. You have Abhishek, Harshil, and Roshan, who are very much at the core of the strategy of Sphere. So it's 7 of us who work on one product as a team, and the intensity with which we have worked has only improved over time, and it's only set to get better. Every decision is debated. Even buying a 0.5% decision can be a subject of debate. And then we arrive at a decision, and then we implement the decision. The big difference between RIA and Sphere would be in execution and productivity. That would make a massive difference. And I'm quite sure that that difference will be felt by you in your experience going forward. But let's now briefly look at the RIA track record. The RIA track record for those who began in 2011 onwards, we have given 4 periods where people have joined the RIA. And the long-term performance for the average investor has been very reasonable. We have beaten inflation consistently. And the most critical aspect of this is that we have taken lesser risk to achieve this. For example, most of the returns in your benchmarks usually come from a small subset of stocks. We generally have achieved the returns even without owning those stocks. For example, the bull run to 18,000 was driven by a set of stocks which we never owned. And yet, using more attractively valued thematic funds, we were able to achieve that. The other thing which you will be able to appreciate is that we have been holding gold for the last 6 years. It has been a soft performer over this 6-year period, but from a risk management perspective, it's very important. That's why the portfolios held well during COVID. But despite that, the equity performance has been significant. So we have run a balanced fund and still beaten inflation significantly. The belief is that if we are able to raise the efficiency and productivity, then we will be able to do even better going forward. It was with this belief that we began Sphere early or late last year or early this year. So what comes next can only get better because the process of decision making and execution will be very, very smooth and there will be no lag. Sometimes investor would be traveling, he would be busy with something else. There will be some other emergency which stops the investor from participating. Execution, which is approval of decisions, may take time. So many factors have impeded the structure of the RIA, which will not happen in a PMS, which is why we chose the PMS. We productized the service and we have clearly seen the benefits over the last 1 year. What comes next can only be better because productivity can be improved and efficiency will always gain. So you will see these two translating into performance over an extended period of time. Many of you are familiar with what we do in Sphere. Sphere thinks thematically. It assembles teams alongside each other and builds a portfolio which is complementary and which also can work more synergistically. So what is a theme? A theme is a broad idea that opens up multiple opportunities. If I say I'm positive on financials, then there are different ways in which I can view the financial theme itself. I can view it through insurance, I can view it through savings, I can view it through credit, I can view it through credit rating, I can view it through depositories, I can view it through platforms, I can view it through microfinance, I can view it through NBFCs, small finance banks, multiple options. So the opportunities are spread across multiple channels. If I view it through macroeconomics, I can view it through inflation, I can view it through deflation, I can view it through multiple streams. So the financial theme alone can be broken into multiple sub-themes. Now we're going to talk about one small theme, which is inflation. So many of you notice that we have been very bullish on public banks and generally financials in general. What did we do? We are betting that when the growth comes back, is the screen visible? Somebody is saying the screen is blank. Can you just check? Just give it a minute. Are you able to see the screen? Can you just put a hands up or something? Right. So when you see that inflation is rising throughout the world and that the credit growth is going to be faster, inflation itself, which is seen as a problem waiting to be solved, becomes an opportunity to invest. Because you know that there's going to be a rush to get credit in time. People want to not miss out on the opportunity for growth. And people don't want to waste a crisis, even if it's inflationary. So you saw the interest rates rise, but you are positioned for that because of the type of investments that we make. What can we do? We can buy those who give credit. So you had the public banks, you had the private banks. And then You can have the assets where the profits go up because of inflation. There are some assets that benefit when you have inflation. For example, commodities, metals, they all benefit from inflation. Inflation usually benefits gold too, but that's happening with the lag. So if inflation is a theme, we can align multiple sub-themes that support the main theme and build a portfolio around inflation. So today, if you see your Sphere portfolio, it's completely aligned to where macroeconomically the world is going and where India is going. So that is where thematic investing is very structural and very structured. It is not random. It's not something where you suddenly decide to buy an industry or a theme because you like it. You are aligning it up to what is happening in the world and what is happening in the country. This alignment itself acts as the first line of defense in our investing. That is why when markets go down irrationally, we are able to buy more. By following this approach, we are ensuring that you are able to invest more when the market is overcome by fear. Effectively, you become greedy when the market is fearful, but it's not so easy. So why is thematic investing difficult? I'm going to talk about that. First, when you see a big picture vision, you're seeing inflation, right? You're seeing the prices go up. Your first reaction is you think negatively. You feel this is a crisis. We are all going to suffer. So you start thinking that maybe you should wait for this crisis to blow over and then invest. It's the natural way to look at it. But every crisis always brings an opportunity. You saw through the COVID crisis, so many industries doing well because of the crisis. And now, when COVID recedes, you are seeing other industries doing well, which were affected then, but which get benefited now. So the alignment to the big picture helps you to participate in the immediate opportunities and also see what are the opportunities that will emerge when these opportunities mature. So it's a 360-degree view of a situation, and it keeps turning gradually, very, very slowly. And you have to be always investing ahead of that turn, ahead of that movement. So it's difficult because there's a lot of preparation, there's a lot of patience needed, there's a waiting component, and there is also a process of change which is working 360 degrees at a slow pace. It's like a giant wheel of opinion moving around, right? Now in this giant wheel, there'll be many products which you have to place, and it's not easy. I see a lot of people say that, oh, it's very easy, just do indexing. You'll be surprised to note that as of yesterday, the NSE has 150 index products. It has got 150 indices. In this 150, you have to select 2 or 3, even if you do index investing. Because all indices won't do well. If you look at what the Nifty itself has done from January 1 to today, it's not too good. In fact, Nifty has barely matched or slightly lagged inflation. I'm not taking yesterday's thing. I saw a day for yesterday. It was lagging maybe just a marginal difference. So, despite investing in equity as an asset class, if you had chosen Nifty on Jan 1, it's not helped you beat inflation. Whereas there are other themes, sub-themes, which have worked extremely well during this period also, and many of you are seeing those sub-themes in your portfolio. But we can't escape the fact that there are too many products to choose from. You're spoiled for choice, it's very difficult. So the challenge is to choose between the outliers, which we do in your thematic investing, and betting on a broad recovery, which is what Nifty investing or large cap investing or small cap investing has turned out to be in the last 1 year. That is why you are doing better despite owning a very eclectic mix of defensive themes also. Whereas the broad recovery is not reflecting in the products like index funds. So there is a way in which this has to be done. This is a lot of wait and watch investing. You need to stagger your entry and exit. One thing which we learned through the RIA is that you have to slow your investing down significantly most of the time, and you have to accelerate your investing only for some part of the time. So the pace at which you build your portfolio or rebuild your portfolio when you have created liquidity, or scale up your portfolio when you have more money to be deployed, has to be very measured. And it's only under very, very unique circumstances that you will hit the accelerator pedal. Most of the time, you are in cruise control mode. But cruise control in investing is not just sitting and watching. It's about going at a steady pace and doing a few things right and ensuring that everything is going right. So wait and watch investing happens all the time, and you need to stagger both your entry and your exit. I told you there are 150 themes to choose from. So how do you build the conviction in contrarian ideas? First, you need to ignore the market noise. There's too much noise around us. Today, you'll all be seeing that PSU is the toast of the season. And I'm sure all of you know how long we are labored with the PSUs. There have been investors who have told me that you don't know investing because you are doing this. You have to just wait for time to validate what we are doing. There's no point in arguing. But that's the nature of that beast. Conviction in contrarian ideas is not something that is going to take off the 100-meter sprinter takes off from his starting block. It's never going to happen that way. It will suddenly pick up space and it will suddenly race ahead and it will widen the gap between the contrarian idea and whatever you are comparing it with, a benchmark. Which means that you need to ignore the market noise and keep investing. When tech was the flavor of the season, we started slowly. Then when the tech choices which we made were very soft, we invested actively. And today again we have paused, taken the leg off, and the investments have definitely done well. Contrast this to how market was recommending tech in 2022, and you will know why conviction in contrarian investing is why it needs to be deployed in a certain way. Then you have ideas which are complementing ideas. Let me explain. Right through the RIA and through Sphere, and you will see this run right through our work. You create a balance between multiple approaches which are contradictory and complementary, both. How can something which is contradictory be complementary? I'll explain. In every portfolio, there will be investments which benefit when exports are better. And there will be investments which benefit when it is a more conducive economic situation for imports. There will be businesses which benefit when inflation is happening. There will be businesses which benefit when inflation is falling. There will be businesses which benefit from credit growth. There will be businesses which do better when credit is very difficult to find. Businesses which run on their own capital. So, along different lines, you can always assemble complementing ideas and create a portfolio of such complementing ideas. All this definitely will make thematic investing difficult. It's not meant to be easy. Definitely not easy. Because the clarity and precision with which you act in a products portfolio, and which is actually what looks like a portfolio of very simple choices, is staggering. It's more difficult than direct equity investing. Then you have the complementing thing between direct equity, mutual fund, ETF, and global. 4 things. How can we complement? So, should we buy only gold, or should we buy gold mining funds also? Or should we buy gold and silver ETFs, and should we also buy mining funds? What should be the mix between these? How much should be in commodities, and how will that complement the regular equity portfolio? Where should you invest for new investors who give money every day? All these things will need very high conviction in contrarian ideas and a complementing choice of ideas. Naturally, all this makes thematic investing very difficult. It's not easy. On paper, we can all say, but when it comes to applying in practice, then we start feeling the difficulty. Also, you have the problem of you being early while market is not taking interest in something. This affects your performance, which means the investor may sometimes be may sometimes not be aligned to supporting such a investment approach. That can be very, very difficult because many investors won't participate and they will miss out. And overall, it appears that the approach itself has kind of missed out on the opportunity. That is not true. The investor has missed out. There are others who have participated. So all this makes thematic investing extremely difficult, and it puts the pressure on us. So why bring PMS to thematic investing? That is the next point. Let's go to the next point. First, it helps improve the efficiency. Transactions happen smoothly. You don't have to go to approve every decision to the investor. You don't have to create an exchange. You don't have to publicly debate the decision. If you're convinced, the manager can create a hassle-free transaction. We are able to see all the portfolios in one place comfortably, compare. So that gives centralized management. Cost efficiency actually improves. Let me explain. Earlier in the model, we had mutual funds and then RIA. So it is a innately double cost system. Now we have shares, mutual fund, ETF, global funds, 4 things. Naturally, the cost will come down significantly. Then you have improved or increased product diversity. Frankly, the market has got no product like Sphere. We compared with one product of one prominent bank and found that it was very, very poorly structured in terms of liquidity. In Sphere, there is no exit loan. So if somebody puts 1 or 2 crores and he wants monthly money, he can take. Our idea is not to hold the client through agreement to the product. I want the client to be with the product and I want him to be held by conviction. We should own him because of his conviction in us and not because we have put a clause in a contract. So that is what differentiates a PMS over an RIA. We are able to bring the efficiency and we will improve the productivity. And the investor will be able to get a more peaceful ownership experience. He need not approve every single decision, which many clients of ours, many investors were upset about. So those pain points were. Then there is also the changing regulatory landscape, which makes it very, very difficult for the investor. Suppose I asked you to approve 5 times. The 2-factor authentication, you need to click 10 times. Most of you are extremely busy with your regular routines, and it's not fair to expect investor to participate so much in just execution. And the law in RIA doesn't permit it any other way. I can't approve your decision. It has to be done by the investor. So seeing all this, we felt the time was right for the PMS to give a better experience to investors who have believed in our philosophy, but who are hassled by the RIA process. So we are also able to bring product diversity of a higher order. It's increased significantly. For example, we have shares, we have ETFs, then we have mutual funds, we have domestic mutual fund, global mutual fund, then you have metals, you have gold and silver, then you have global funds, the works. So what does all this translate into? In one word, all this translates into versatility of an order which has not been seen before, I now hand you over to Samyukta to speak about how Sphere brings versatility to your investing.
Yeah, sorry.
Yeah, now you can
I
speak.
think Harshal will take this part.
Okay. Yeah, Harshit, sorry, I put you on to stand. Sorry,
Thank
I
you, sir.
asked you to put you. Yeah.
So why do we say sphere is versatile? Now you can call something versatile if it has many or different uses. Now if you look at how the market really functions, it's cyclical in nature, which means that there is a bad time and a good time, but not necessarily for every asset or every sector. Right. This means that the market gives us an opportunity in multiple asset classes across different sectors and across different geographies as well, given that everything is now easily accessible to us. Now, because opportunity is open across the board, we wanted to make the best use of every cycle. Right. So Sphere allows us to take advantage of these cycles because our universe is dynamic and flexible in nature. Now, now we started, I thought, a decade back with the idea of being conscious of what we pay for a business and staying away from what the market fancies. Right. So, like any other product in the iThought ecosystem, Sphere also follows the same philosophy of being contrarian and value oriented. Right. Now, Sphere is the only product in the iThought ecosystem that follows a top-down approach. Right. So the team spends a lot of time understanding and analyzing macro trends, both domestically and globally, for us to actually form an investment hypothesis. Right. Uh, Sam, you can go to the next slide. Right. So let's look at how we actually took advantage of a cyclical bottom in a theme using the top-down approach in iThought style. Right. Everybody remembers how pharma was the most loved sector in 2020 because of the pandemic. Right. The sector outperformed the broader index by 45%. But what actually came before the boom was a long test of patience. Right. So if everyone remembers, we started buying the sector at the fag end of 2017, and at that point in time, small and mid caps saw a huge boom. Right, and the market's risk appetite was increasing dramatically. Right, our economy was also trying to heat up, both in both our country and globally. We started seeing signs of heating up. Right, we felt that it was time to take a more defensive stance. Right. So when we looked at the pharma sector, the sector had corrected nearly 40% from its peak in 2015. Right. Back then, the industry dynamics were different, and since its correction, the industry dynamics started changing. Right. Larger players started focusing more on domestic sales and had started investing in more specialty formulations. Now, one interesting thing about Indian pharma is that China, with all its capabilities in the world, could not manage to come out on top. Right. Our country is the leading drug manufacturer in the world. Now, when you have the world's leader at extremely cheap valuations, you cannot let it be. So we started buying the sector very slowly. Our approach was that we have to take a more staggered approach because cheap can remain cheap for a very long time. Right. So we started buying the sector very slowly over the course of 3.5 years. And conviction demands responsibility, right? Thematic investing requires consistent contribution, topped up with patience. So for the next 3 odd years, we started scaling up on our conviction idea, where we continuously bought huge quantities of the sector via the mutual fund route, because we were looking at a more broad-based rally. So we decided to take via the mutual fund route. Now, exposure to the sector was nearly 20% right before the pandemic. So we took 3 odd years to build positions slowly from 5, 10, 15, and then gradually brought it to 20%, looking at the fundamentals of the sector. Right. Over time, the sector came to light, and with our staggered entry, our approach was also staggered exit. Right. So if you see, we have been selling out since the pandemic, and we were out of the sector. The result was a good 20% annualized return on investment, where it took us 3.5 years just to build the entire position, and then when the market gives us that opportunity, when we're sitting tight, when we get the exit, we can just ride the momentum and usually make those returns. Right. Sam, you can move on to the next slide. Right. So Sphere is a multi-product portfolio with thematic investment at its core. Right. So when we want to play a particular theme and we figured out that this theme is extremely attractive, we don't look at it from a product approach. We look at it as a mix of stocks, ETFs, and mutual funds, where we have no upper cap on a particular theme or a particular product. Right. So we don't have any cap on asset class, for example, debt, nor do we have a cap on a particular sector. Right. So this is what Sphere is actually made of. Sam, I would like for you to come in and start taking over from here. Thank you.
Thanks, Harshal. Am I audible? Okay. So moving on from what Harshal was talking about, when we are looking at products within Sphere, our entire focus on selecting a product is completely investor centric. So what do we actually mean by this? We begin with understanding a thematic idea because that is essentially the core of what Sphere is. And then we look at whether that thematic idea is going to throw up broad-based opportunities or if those opportunities are going to be more selective. Now, if we have a very selective like if we know that there are only going to be a few outliers in a particular thematic idea, then we know that that position needs to be actively managed, and possibly the best route for us in that situation is going to be through stocks. So one of the holdings in the Sphere portfolios is HDFC, and this is how we've played that particular thematic idea when we were looking at banking as well as housing as a sector doing well. Then we sort of filtered into this particular stock, and we also realized that the merger is going to throw up a better valuation opportunity for us. But sometimes these opportunities can also be more broad-based, and in that situation, our team will deliberate over whether these opportunities need to be captured in a system that is actively managed or whether passive management is sufficient. So, for instance, when we talked about PSU, when Shamsa mentioned that earlier, we felt that the entire PSU bank system was sort of undervalued, right? And because the whole pack was undervalued, it made sense for us to look at a ETF or an index-based fund where we would benefit from holding the entire lot and not looking at one or two specific outliers, although we did expect, say, a bank like SBI to do really well. At the same time, if we know that there has to be active management, Harshal just walked us through the entire example of how we've invested in PHARMA and what a staggered entry and exit we did in that particular investment, right? So we know that this sector is going to do well, and then we look at a well-managed mutual fund. So when we talk about mutual funds in Sphere, it's not going to be a typical run-of-the-mill mutual funds. It's going to be something that is extremely well managed, probably catering to a particular sector or thematic idea that we have worked on together as a team. So just to give you an overview of what your current product allocation looks like, Harshal did mention that we could go anywhere between 0 to 100 on any asset or any product in the portfolio. So as of last month end, that is October 31st, we had about 44% in stocks. We had about 27% in mutual funds and about 19% in ETFs and 10% in cash. Now, today we have basically invested some of that cash and some of that mutual funds into increasing your ETF as well as stock allocation as opportunities have come up. So we've been very gradual in the way that we're changing your product mix based on opportunities. And if we look at your asset allocation also, your equity has about 60%, 62% today, and your debt is about 13%. So that's basically your money market funds, which we've been holding where we're getting a better yield than cash. And we also know that in this market, we're going to be deploying a little bit more gradually. Then we've got 10% in metals, that is across gold and silver, and we've held 10% cash. And we've also got global investments to the tune of 5%. And just to take a quick look at how our performance has been, as of last month, I think our performance since inception, which is less than a year, has been about 9.39. And I think from earlier this week, our performance has been even better. It's been closer to 16% since inception, and our 1 month performance is 9%. So we have talked about PSU, and that has been a big driver, and we're seeing a lot of our engines fire. And this is a great time for us to be giving more focus into Sphere and what it can actually deliver for the consistent investor. So keeping that in mind, I think our key message here is that the world is actually at your feet, right? Because today with the PMS, we have more sectors to choose from to produce focused results. So when we are looking at sectoral allocation, we're looking at concentration. We saw how our pharma position gradually we built it to about 20% of the portfolio. And then we also have more markets to choose from today. And this will add dimensionality to the portfolios because we're not only India centric, we're able to move across the globe through ETFs and global funds. We also have more assets to choose from because we are no longer looking at only equity. So if you see your portfolios, even in the RIA phase as well as today, we've been able to add metals, we've been able to bring in a little bit of debt as well today in terms of money market funds. And we also have more products to choose from. And we were looking at product diversity, something that Shyam sir had mentioned. Sorry, there was something from one of the participants. I missed that message. Is there anything to address? Okay.
Go on, it is the corresponding slide. It is the corresponding slide.
Okay, got it. And if we're looking at finding your fit, right, for an investor who's coming into Sphere today, if we're looking at finding your fit, we are looking to work with with investors who have a 7-year investment horizon or longer, who are focused on wealth accumulation, because this is a portfolio which can actually compound over time because we're gradually building positions, we're taking more concentrated investment positions, and where it's a high conviction portfolio. So this is suitable for your long-term goals. If you're coming in with a minimum of say 50 lakhs, you want to try out how the product works, we can map it to any one of your goals. And for those who have built this habit of consistently saving month on month or every quarter putting in a certain savings target into your portfolio, even that is possible within Sphere, and that is something that we're also working with all of our clients and investors on. And if when it comes to retirement planning, we look at Sphere as a portfolio where you can actually build your nest egg. Given the time horizon of say 7 to 10 years, it's not, you can start early as well. You don't have to wait say 10 years to retirement. Since this is a longer term compounding kind of portfolio management service, it would suit anybody who is saving towards retirement. When we say that it's not suitable towards regular payouts, if you come in with the minimum and from day one you want a payout, that is not the kind of product that Sphere can be. But if we're able to build over a period of time, then of course we can start looking at how to do this, and there will be a seamless coordination between your financial planner, your investment strategist, as well as your client associate within the ithought ecosystem, and we'll ensure that whatever you need for is definitely provided and taken care of. And like I mentioned earlier, as well as what's been on all of our product brochures, we look at this as a 7 to 10 year product where we can really have a long-term relationship with you, and we give your portfolio enough time and energy and attention to really grow. And now I'll just hand it back to Shyam sir to wrap up.
Yeah, thank you again. So while this product is extremely versatile, it can align to specific goals, it can easily fulfill larger goals like retirement, like wealth creation corpus, and even other goals. It also has a certain flexibility. We have not actually even put an exit load on the product, so people can use it like a wealth corpus from which they can even take regular money after retirement. So it's got a lot of flexibility. We are supremely confident that the investor will stay in this product and gain more, and we are not binding an investor to the product. That's one of the important aspects of this product. But this product is for people who really want to improve their efficiency, bring productivity, and then achieve the outcome. It is not a product which chases fads and trends just in the nick of time. What do I mean by this? I'll give you a small example. Through our RIA, those who have been with us for 10, 12 years will know how much returns we've made in the small cap space, how much return we made in banking space. But we didn't enter any of these products in the nick of time. We were very well positioned between 2011 and 14 to make money between 2014 and 18. In January 2018, we have exited these positions and we have not gone back to small cap yet. It's 4 years. It's not a small duration of time. So we are very patient with teams. It's not as if we are not bullish on small cap, but I feel the market is chasing small caps based on recency bias, and there will be a price to that. When that price happens, then it will come into our zone, and we will probably be entering those teams when others are not very sure or confident. Look at what we are doing in the public sector bank team, and you will understand that you spend 3-4 years in the RIA, and then in the 5th year or 6th year, we are seeing all these people come in and chase the fad now, and they are going to give you the returns. So you need to be very patient with teams. I've seen a lot of people not want to own even a single fund or team in a portfolio which is not performing. They talk only about a non-performing one. If you really want this product to work for you, then you have to understand how to be patient with teams, because that is how the results will happen. This is a long and drawn out process through which we take lesser risk to make more returns. But time is the key ingredient if you want to achieve this. So buying at the right asset at the right time is a statement made here. It does not mean buying the right asset in the nick of time. It means buying the right asset when it is favorably valued and then building it into a significant position over time. Not buying it JIT, just in time. Because this just in time business will sometimes make you buy assets at the wrong time. If you buy late, you're gone. It is also to the credit of Sphere and makes it work better for you that we engage with opportunities. I'll give you an example. We have been invested with many teams for long periods of time, and then the team fires suddenly. So this engagement period builds our conviction. It makes us stress test the opportunity, ask ourselves, are we wrong? Where are we going wrong? Or is the market not seeing what we are seeing? Why is the market not seeing what we are seeing? All this is constant engagement. Sometimes we could actually have seen it wrong or too early. Both are possible. If we have seen it wrong, then we will take that engagement to the right place and close it. If you have seen it early, we will understand how to manage it till the time is right. For us to achieve that, we need consistent contribution. If you ask me what is the single biggest problem point or trouble point for us in the RIA, it was people telling, I'll give you money after I see returns improve. Now, clearly, this is like telling a doctor that I will take your prescription seriously after my health is improved. You don't need a doctor at that time, actually. So, you need to take the prescriptions regularly. You need to medicate yourself correctly to overcome what problem you went to the doctor for. So, there is a consistent contribution which you need to do in a prescriptive relationship. If you ask me, that was the biggest reason why people's RIA experience was subpar. For some people, it was subpar. Refusal to scale up. Now, here is a simple point. Assume I am investing in my own portfolio. Assume I have a Sphere portfolio. I am not giving ithought money. I am giving my portfolio money. I am contributing consistently to my portfolio, as a result of which my portfolio does better. In the mindset of many investors, and this is again a legacy of the banking era, because you think the banker is pestering you and you are giving him money. That is the anchoring in our mind. Because of that anchoring, when some client associate of ours comes to you or we come to you, there are a lot of back and forth and argument and debates, which in my view don't do any good to the eventual cost. What is the cost? The cost is to improve the portfolio, improve its working, and get the outcome we desire. Instead, we don't act. Now, if Sphere has to work for people better than the RIA and better than history, consistent contribution is the key. Every month you must invest some sum. That sum should be reasonable enough to make a difference to your portfolio. And at times when extreme opportunities are before us, you need to contribute more. It's important to have a target towards which you are investing. So I'll tell you a personal learning which I had in the last 4 years. So over a period of time, nearly 26, 27 years, I had invested. I had reached financial freedom. I had more than enough money than I needed. My dividend was reasonable to run my life. How do you focus? What are you working for, right? Even when you have a lot of money, there's a problem. So I had to go back to the drawing board, do a plan, set targets and say that I'm going to invest so much in this area. I'm going to invest so much in this product. I'm going to scale up my exposure to this asset class. I'm going to create a global portfolio of this size. My solitaire portfolio should be at this level. When I started targeting, then I started aligning my investment to the target. And the surprise outcome was the level of efficiency and productivity which I brought to myself. I only wish that every investor who is in the ithought ecosystem is able to achieve what I did in terms of efficiency and productivity, and we are able to get the best out of what we achieve in life. And that best translates in our investments. It should show somewhere, right? It should not be a case where somebody did extremely well in life, but their investments don't reflect that. That is what I expect Sphere to deliver. And the quality of engagement should be with a clear understanding that we're working towards something very, very long range. And by concertedly working towards what we want, towards a target, we are going to get what we want. And we are going to be on top of our money. And our personal finance is going to get maximum value out of our success in our regular life. On that note, I will be opening the session to Q&A, and the team will join me in answering the questions. Thank you very much for your patient hearing. There are some questions that have already been spoken. Right, the first question is on fixed income instruments. Will it be based on macro market opportunity? Will it be based on individual financial standing, age to retirement, and such parameters? Sam, I'll let you take that question.
So we will be looking at this primarily from a macro perspective when it makes sense to allocate to fixed income. There will be an allocation where, for instance, earlier this year we saw money market yields crossing, that is basically debt funds or instruments where it's less than 1 year maturity. We were getting a 7% lock-in availability. So we went in there instead of holding cash because we knew that we were going to gradually deploy. Now, similarly, if we find another strategic entry in terms of say taking like a duration call or a credit call, we might be able to do that. And at the portfolio level, but it will be an allocation. So there will be a target amount that we'll allocate, not specifically for someone who is retired. And in the event that we have individual investors who have a plan in place, who are looking at cash flows, then their strategy will be completely different from what we are doing at a fixed income level.
On the second question also, I want to take traditional FDs.
Sorry, let me just read the full question.
It's the second question. I'll read it for you. In India, for a common man, the inflation is very high. In my understanding, it is nowhere near RBI's number. Given the real interest rates that we get from traditional FDs is mostly negative or too low, how do we handle this? While equity in the long run definitely beats inflation, how to leverage fixed income instruments and still beat inflation is fair and portfolio mix, considering this aspect across business cycles.
Correct. This is something that we are considering in Sphere. So if we look at the portfolio itself, we have about 10% allocation to metals today. We have another 5% in global mining funds, which is also a play on commodities. There is some allocation to natural resources and there is some allocation to fixed income. You're raising this important point of the of the traditional FD not being able to beat inflation, and we are cognizant of that. We are looking at certain fixed income opportunities where you might be able to get a higher yield, which is slightly more tax efficient, or where we're playing a longer term horizon, where again we can do something for an investor where we bring them closer to beating inflation on an overall portfolio level. Each instrument individually may not be able to, but as a combination, we can construct something for someone who is conservative, who wants to take less risk, or who wants income generation.
Thanks, Sam. Niranjan, you can take the third question. I'll invite Niranjan into the discussion. Dollar index strengthening, gold and silver, I believe, have not appreciated a lot. What is your assessment? He has given some numbers about Y2D of minus 10% and yearly minus 7% on silver and gold and all that. Both have underperformed or flat. The question.
Yeah, thank you so much. See, as far as gold is concerned, from where we are seeing, I think what has happened is we're seeing that there are two things that's happened. One is what happens whenever there is a crisis or whenever there is an economic slowdown. What usually happens, am I audible?
Yeah, you are.
Yeah. So what usually happens is you first start seeing the dollar strengthening. That's the first asset to which all the money flow goes to. And then from there on, it slowly starts to move away from the dollar. So in that point, I think a lot of people were touting cryptos to be the alternative, but I think today we know where crypto is, and we don't see that to be anywhere on this. And as far as the metals are concerned, there are not enough metals that are being mined. Just to also give you a heads up on that, the amount of metals that are being mined today, there's no new capex that's coming up. So which means your cost of mining is really going to go up for a lot of these cases. And the other thing that also, if you were to be watching, is that the data on the metal side, on gold or silver for that matter, is that the central banks, the Western central banks, have been consistently selling all the gold out. And that's also the reason why you're seeing gold, price of gold, I would say the word would be slightly muted. So given that fact, I think it's a good place to be in. And also that we are seeing a lot of accumulation that's happening on the emerging economy side. All the emerging economies have been very consistently buying. Just to give you a sense of what's happening since 2016, Russia has been very consistent in buying, deleveraging from the dollar towards gold. And also on the sidelines, if you've been reading the news quite closely, countries are now going towards bilateral agreements. So they're trading within their own currencies. They're trying to deleverage themselves from the dollar. So the DXY, we are seeing that slightly weakening from where it is, and I think this cannot be sustained even for the United States to have a strong dollar at where it is. And the industrial, yes, please.
Yeah, great.
And as far as the industrial consumption on silver is like I would say a leverage play on gold. Silver has two attributes to it: one as a precious metal, and two as an industrial metal. Today, where we are seeing that silver is a leverage play on gold, and so you will see more volatility. Say, for example, if gold moves 1x, okay, if gold moves 1%, you will see silver move 2%. So that's how silver works. So on that note, we are seeing consumption on the emerging market side. So the paradigm also I would like to point out to you is I think the paradigm shift you'll see a decisive shift from the Western world to the emerging economies. Given that fact, you will see a lot of movement on the industrial side, both from the industrial side and on the precious metal side, uh, to the emerging economy side. And that's also the reason why you're seeing such benign prices at where we are.
Can you take the next question? In Sphere PMS, why the PM is not parking cash in any liquid fund? I see decent percentage of cash sitting idle, whereas they earn at least 2.5 to 4% if you are lying in a simple SB account. Of course, there is an operational inconvenience in terms of availability of funds for a day, but there is an opportunity cost from the customer perspective. Can you answer the question?
Yes. See, also to just tell you, our deployment is like what Shyam was saying in the beginning of the conversation, is that our deployment goes in a manner that we deploy about 0.5% or 1% a day. And for us to walk, and there is about, I would say at best about 7-8% that lies in cash. So this 8% would probably deploy in a month or two, or month or a month and a half's time. That's also the reason we keep it in cash as cash, and outside of which we do maintain about a 15-20% that lies in the money market space, which can be used at the opportune time.
Actually, there's one more problem, that is stocks don't give too much time. If you see your portfolio, there are stocks we have bought in single day. The next day it goes up 5%. So only one day somebody comes to sell, that day you have to buy, or the price moves rapidly down and then rapidly up, like a V. Similarly, funds also, there are multiple actions that need to be taken. So if you unless you have 5-6% cash, then that extra day or two sometimes can be quite. I mean, there is a problem of missing out, or the opportunity is not efficiently addressed. For the sake of that efficiency, some cash has to be kept. That is the concept.
And also to add to what Shams is saying, see, we're not keeping a large portion in cash. We're keeping only the portion to which we are ready to deploy in cash. So that for what we strategize for deployment. And also to see there are a lot of stocks. You see the movement, the volatility is quite high. While the index volatility might look very low, the individual stock volatility is quite high at where we are today. So that doesn't give us too many opportunities to be able to sell the liquid fund, then buy it back again, sell the liquid fund, and once the peak margin issue is taken care, and then this is more an operational issue also for us.
So there is a question. I wish to know where and how I can park my savings till a new theme is identified or opportunity arises. Is there any room within Sphere to accumulate my savings? Oh, now I am saving in SIP mode in a debt market instrument.
On this, we would see there are two ways of doing. We have a lot of clients who do give us SIPs on Sphere. So who are giving SIPs on Sphere, where we keep adding to stocks or ETFs or mutual funds as the case may be on a monthly basis. So that happens. The other alternative is you can keep accumulating in the liquid fund, and on probably in about a day's notice or a couple of days notice, you can do the redemption from the liquid side and just send it back in this way.
Okay, here's a question. I'll answer it myself. Is there any plan to invest in IPOs or MFs? Unless the team is really, really good, and I'm very sure that the fund manager has a very robust strategy. Without seeing a portfolio, we would only invest in the rarest of rare circumstances. So we have done it once about 8 years ago, or maybe 9 years ago, in small cap closed-ended funds. We were hugely successful because we felt that the fund manager cannot go wrong even if he wants to. It was so compelling. But having said that, we have not invested in any mutual fund IPO because it's investing blindly without seeing a portfolio, which I would never do. Opportunity on NASDAQ now, since tech stocks corrected significantly. Yes, we are seeing the opportunity and we will gradually scale it up. It has already begun. We already invested in NASDAQ and we continue to invest in NASDAQ. At what intervals the performance report will be shared? Monthly. Your reports will be monthly. So you'll get your reports monthly. What are the tangible goals of Sphere? Kindly state it against inflation Nifty index. So I have a point to make here. Firstly, I have never chased the Nifty. There's a reason. I don't want to invest in Reliance. I don't want to invest in many of the businesses. I don't want to invest in Nestle. I don't want to invest in Asian Paints. I don't want to invest in expensive companies. There are many things I don't want to invest in. So I don't chase the Nifty. But I want to beat inflation consistently by between 4 and 6%. If I do that, then I'm doing well. If I do much better than that, then I'm really in a place where there's nothing to complain. So the benchmark is not Nifty, but we still have to give you a benchmark. They're giving you benchmarks in all products. That is a regulation. But from an investor psychology and mindset, I think that this beating a Nifty is like telling that I should score more marks in a subject over the fellow sitting next to me in class. How much that really helps my learning or makes me better in life is a question mark actually. So in the end, the guy who scored top mark in my class actually ends up earning far less than the guy who was sitting in the last bench. This is life. So likewise, in investing also, we should know what we are racing against and what we are pacing against. All of you know the famous proverbial race of the hare versus the tortoise. So I think that this Nifty is a very overrated. Nifty benchmarking is overrated. Yeah, media people, everyone finds it very convenient. I have never compared with the Nifty. And if you ask me what is my investment success secret, it is that. I have done way better than that because I have not felt constrained every week, every day, every month comparing. And I think that you should ask yourself whether you have done your best at all points in time, every single day in your investment life. If you manage to do that, there will be no reason for you to compare with any benchmark. And I find that most people who do this comparison, they don't do what is needed to be done in their investment role. They do this comparison more and they give up on investment many times. I feel that this is generally avoidable. It'll help you if you compare yourself with inflation and see how you're doing than with an index like a Nifty, which has got a lot of expensive companies and a lot of companies can get manipulated as well. And overall, if you see Nifty long run, it makes 10%. That's what it does. What are the tangible? That's what I said. The tangible goal is to make use of opportunity, bring efficiency and productivity, which will make you a significant gainer over your return expectations and over inflation. That is the idea. How frequently shall we have meetings like this? In RIA, it was missing because you cannot have everyone in one meeting because the portfolios are customized. Many investors choose to invest in something, don't choose to invest in something. But here it's relatively more homogeneous. The meetings will be reasonably frequent. I don't know at what frequency, but it will be frequent enough. I also don't want it to become very frequent where it, maybe you feel that it's too laborious. But when we have to say something on a theme or when we want to convince you that you should invest more, when we feel something compelling to share with you, without hesitation, we will hold these events. The frequency will be more than the RIA, that is for sure. Thank you, Milind. Thank you for your feedback. Any other questions? We'll be happy to answer you. Thank you, Bindu. I'd like to express my thanks to Subhashni and Ramakrishnan for all the questions they asked, very good questions. And Prabhakar, again, very, very important questions. Vijay, also for a very relevant question. For Ramesh, for the comparison, it's very, very important that we understand what we are working towards. Milind, Bindu, I thank all of you. Thank you, Mundalini, Tanigai Vasan. Oh, there are plenty of people better than me in the firm, Ram. You can be assured about that. There are plenty of people. We have a research strength which is probably more than firms 10 times our size. I'll put it that way. Thank you, Suresh. Thank you so much. Thank you, Vaidi. Thank you. Any other questions? Thank you, Vishi. Thanks, Shivkumar. Thank you so much. Thank you, Radhika. Thanks, Sandeep. So if there are any other questions, you can always reach out to us. We'll be happy to answer your questions. The idea is to speak transparently and share our thoughts. So there is merit in doing that because I believe that will improve efficiency and productivity. And Raghavan wants an offsite in Hyderabad. Okay, sure. See you soon. So the idea is to share our ideas so that we are all on the same page and the investment actions get done in time. I think that will really improve our productivity and efficiency. Little actions can really improve our investment performance, and we will never have a need to discuss performance. I think that's the best place for all of us to be in, and we hope to get there soon with your cooperation and all your support. Thank you very much and have a great weekend. Thank you so much.